Overcoming the limitations of backtests. This is Bill Scheid from Applied Finance Research, and that's the question we're going to explore in this video. For this exploration, let's begin by talking first about 5 of the major limitations of backtests. There are more than 5, but these are the major ones to be aware of for any backtest that you run on any type of system. So first is sample size. If our sample is too small, then our backtest probably does not give us an accurate representation of system performance over the long term. This means that our backtest data may not be reliable and our real-time trading results will probably not generate the same type of results that we see in our backtests. Next is over-optimization. If we over-optimize a system and we tweak the rules so that we have overfitted the system to historical data, then there's a good chance that the system will show exceptional performance on the past data, but perform poorly in real-time trading. Then there's market type. There are many different possible ways to classify market type. If you're a student of Dr. Van Tharp or Dr. Ken Long, then you're likely familiar with the 9 market type matrix that they use. And if we run our backtest over one of these market types, but we trade our system in another market type, then our backtest will likely not be representative of actual system performance. Next is sequence of return. The shape of the equity curve created by any backtest is specific to the order in which the trades were taken. And if we take those exact same results and we reorder them, we'll get a different shape to our equity curve because math. And that means that our maximum drawdown will be different, the length of our drawdown will be different if we measure by minutes, days, weeks, months. Our total return will be different. And this is important because while the future may rhyme with the past, it won't be exactly the same. And finally, commissions and slippage. These can be material and have a significant impact on real-time trading. If we don't account for them in our backtest process, then our real-time results may be significantly different than what we expect from our backtest. Again, there are more limitations when it comes to backtests, but these are 5 of the major ones that can create problems for traders and investors. So now that we've identified these, let's talk about how to overcome them. Let's start with sample size. So generally, we need a minimum of approximately 30 trades to achieve any type of statistical significance. For me personally, I'd prefer to see a minimum of 100 trades. This is something that I learned from Dr. Van Tharp. And personally, as a trader, as an investor, I feel more comfortable with a larger sample size as I believe that this will be a more accurate representation of system performance. So let's take a look at an example backtest. Here the green line is the system performance and the blue line is the performance of the S&P 500. And note that we have 418 trades here. That's more than 4 times what I personally like to see as a researcher. To illustrate the point, if we just took a small backtest sample of trades, let's say from 2016, when the equity curve is flat, that would not be very representative of the overall system performance. Or if we just took a small backtest from, let's say, 2020, when the equity curve is very steep, that also would not be very representative of the overall system performance. On the whole, this system nicely outperforms the S&P, and it has an average compounded annual growth rate of 13.4%. This is a system that I'm personally trading. It's called BMR21, and I teach this in our Momentum System Home Study course. And I'm more confident personally that future results will resemble these past results because we have 418 trades instead of just 15 or 20 or some small number like that. Now, that's not a guarantee of future performance, and there are certainly other factors involved, but the point is that we want to have a large enough sample size in our backtests so that we can develop robust systems that perform well in a variety of real-world conditions. Next is over-optimization. If we over-optimize a system and we tweak the rules so that we've overfitted the system to the historical data, then it's likely that our system will perform poorly in real-time trading. So one critical factor to pay attention to here is the degrees of freedom or number of rules in our system. The greater the degrees of freedom or the bigger the number of rules in our system, the greater the risk of over-optimizing. It's possible to just keep adding rule after rule after rule so that our system buys at the low of every market pullback and sells at the highs of every bull run, but that's over historical data. And when it comes to real-time trading, that set of rules is not likely to achieve that same level of performance. As a researcher, investor, and trader, I believe in the value and the power of simplicity. A simple rule set with only a few degrees of freedom is much less likely to be over-optimized. Sure, our backtest results may not look as impressive as an over-optimized set of rules, but our real-time performance is more likely to match our research, and we may avoid the kind of unfulfilled expectations and nasty surprises that come with an over-optimized system. As an example, here are the results from a simple monthly system with only 3 rules. Only 3 rules. The green line again is the system performance and the blue line is the S&P 500. So here we see that the system outperforms the S&P quite nicely with 3 rules that are caveman simple, and we have a very low risk of over optimization. This is another system I'm personally trading. It's called the PMA SPY system. I teach this one in our Portfolio Moving Average Home Study course. And of course, the other advantage to a simple set of rules is that it can be easy and fast to learn, and it also has a low cognitive load, which in my view is one of the biggest hidden costs of trading and investing. Next, let's look at market type. If we run our backtest over one market type but trade our system in another market type, then our backtest will likely not represent what our actual system performance is going to look like in the real world. So the first thing to consider is that we need a clear definition of market type. There are many different possible ways to classify market type. Again, if you have studied with Dr. Van Tharp or Dr. Ken Long, you probably know their 9 market type matrix that takes into account directionality as well as volatility. You could use this as your definition or any different definition that you create for yourself, but the point is you need a clear categorization of market type. From there, then it's critically important that we backtest over the same market type or market types that we're actually going to trade in real life. As an example, if we look at the 2 backtests we've talked about so far, they run from 2007 to 2024. So included here is the financial crisis of 2008, the COVID crash of 2020, the inflationary period of the recent years, and everything in between. So no matter how you define market types, there are a number of different market types included in these backtests, and that's going to give us a more robust representation of system performance than if we just ran the backtest over one market type. Now, we could run a backtest over just one market type, but then we would only want to trade that system in that same given market type if we want our real-time performance to resemble our backtest. The important point here is that whatever market type or types we plan to trade our system in, they must be represented in our backtests. Next is sequence of return. This is important because we know that the future will never be exactly the same as the past. It might rhyme, but it won't be exactly the same. And even if we assume that a given backtest is an accurate sample of the trades we'll get in the future, those results, those future trades, they won't happen in the same sequence as the past. And what's important to know is that if we reorder the sequence of trades, our equity curve will look different. It'll have a different shape, a different maximum drawdown, and a different ending equity. So the important point here is that sequence determines a lot of the important statistics that we like to look at in our system performance, such as maximum drawdown, total return, etc. Now, this is where Monte Carlo simulations come into play. One way to think about how Monte Carlo simulations work is the idea that our system is like a black box that we can't see inside. So we reach into the box and we pull out a result. The result is a trade with a given percent gain or loss or given R multiple gain or loss. We don't know what the next result is going to be when we reach in, Just like we don't know what the result of a trade is going to be at the time we enter. But if we're willing to assume that our backtest results are a representative sample of the kind of results our system will generate in the future, then we can do a mental exercise similar to Dr. Van Tharp's famous marble game. We take the backtest results, we put them inside our hypothetical black box, we pull them out one at a time in random order, and we draw a new equity curve based on the new sequence of results. At the end of one run of trades, we'll have a new equity curve with a new shape. Now, let's say we repeat that process 500 times or 1,000 times. We pull out all the trades, we draw an equity curve, we throw them back in the box, we pull them out again. Again, 500 times or 1,000 times, we're going to end up with 500 or 1,000 different equity curves, and it would end up looking something like this. This is an image from the Van Tharp Institute Position Sizing Home Study course. And here we've got a sample of 100 backtest trades, and we've graphed 200 runs of those, 200 random sequences. Each run is a different color, and we can see that there's quite a bit of variation in the shapes of the equity curves because the sequence of trades is different for each run. Each run is going to have a different maximum drawdown, a different return, a different ending equity, etc. At this point, it looks like a bunch of dog vomit, to borrow a phrase from Dr. Ken Long, but we can use math to help us analyze what we have here. So for example, we could find the average of all these runs, and that's depicted here by the black line in the center. We could also find the maximum, the minimum. We could find the average plus 1 standard deviation or minus 1 standard deviation. And then we end up with a much more comprehensive understanding of what our system performance could look like going forward. Finally, we have commissions and slippage. These can have a material impact on our real-time trading, and if we don't account for them in the backtest process, then our real-time results will likely look a lot different than our backtest. So we want to keep in mind that commissions and slippage will vary greatly from trader to trader based on factors like broker, country of residence, trade size, etc. They will also vary from system to system, depending on frequency of trading, trading vehicle, order type used, and type of market traded. For example, volatile markets, they might have more slippage than a quiet market. In our research protocol, we use the idea of backtest, paper trade, prototype, then production. This is something I learned from Dr. Ken Long. And the prototype phase is where we can get a good sense of commissions and slippage. The prototype phase is where we take real-time trades with real money, but at very small position size and very low risk. Because we're using real money in real time, we can start to measure slippage and we can keep track of commissions. So this can give us a sense of the impact that commissions and slippage will have on our actual results when we scale up to full size in the production phase. So that's an overview of some of the limitations of backtests and how to overcome them. This is Bill Scheid from Applied Finance Research. Thank you very much for watching, and happy investing.